Okay, thank you. We just started the recording, so there you go. You all got the little notification. Um, Thank you, Rachel. I'm sort of curious to hear from you both whether the risks that a buyer is like most curious about or like paying most attention to are the same ones that you all see as the biggest risks to a project.
I'll quickly
And
chime in that there are some people in the audience members that are saying the chat is disabled, Margaret. So
yeah.
just to let you know that everything's coming in via the Q&A. But audience, we do hear you. We acknowledge you.
Okay, thank you, Rachel.
To quickly answer your question surrounding whether or not these risks seem to be the most popular ones, I think something that we see quite a bit in the markets is people aren't aware of the risks that these projects face. And so some are obviously very natural to understand, for example, the natural catastrophe risks and climatic risks, and these are fairly straightforward for people to grasp. But a lot of the times we see buyers that aren't essentially aware of what other risks their projects might be facing when it comes to regulatory risks, when it comes to political risks. The amount of awareness that we see contextually within the carbon markets or within the group of people buying these credits is fairly limited. And so a lot of what and I'll let Rachel chime into this as well, but a lot of what Rachel, Ailish, and other members of our team do is generate this awareness. And so you don't know what you don't know. And essentially that's where our entire process begins. But I would like to say that we're fairly consistent across the board in terms of what we offer and all the risks that are available or all the risks that projects face. And those are, yeah, the ones that we just chatted about.
Yeah, from our perspective, I can dive in as well. I think one of the key risks that we see with projects is additionality that needs to be evaluated on a per project type basis, and it really has an impact on whether it gets a score or not from Renoster. So if it isn't additional, it gets a 0. If it is additional, then we can consider all the other aspects of the project, and that's really central to any carbon project, being real and having efficacy. We've had projects that are well renowned in the public or in the media or in the, I guess, the VCM writ large, that we found to not have any additionality. Either they experience gerrymandering to extreme degrees, or they have their monoculture plantations in and amongst a whole sea of monoculture plantations that result in pretty much no reason for this project needing carbon credits to exist, and therefore it would get a failing score from Renoster. So those, I would say that's probably of all of the variables, probably the biggest one to get right, and to be cognizant of when buying credits. And everything else is a shade of gray per se, compared to this very clear black and white.
Okay, so now I want to turn to, okay, so that's the stage of like, what are the risks that buyers are facing when they're trying to understand whether to fund or buy from credits from a project. So now I'm curious how the tools that you each work on are changing how buyers think about that. And I want to start with insurance. Manzi, have you seen how having access to insurance has changed how a buyer thinks about purchasing a project, or how financing can come together for a project?
Yes. However, I think we're still far from where we'd like to be when it comes to insurance unlocking the capital required to expand the scale of these projects to the scale that we need for appropriate climate action. I think just generally the concept of insurance is one that instills faith in people, and that's exactly what we're trying to do. Whenever we get into conversations with people about how insurance can actually help, we're in the business of building trust, I think, as I like to call it. And so essentially what we're trying to do is give you faith that any finance that you invest, any capital that you invest into a project will reap the benefits that you intend for it to. And so I definitely think that we're getting closer to unlocking more and more capital because of providing insurance. However, I think because this is such a nascent industry and this is such a niche field when it comes to providing insurance for nature-based solutions, solutions that actually go through quite a bit of risk from all different aspects. We're still a while away from having the amount of faith that we'd like to in the industry. Rachel is more, I guess, focused on the client side of things, and so I'm going to let her chime in as well.
Yeah, I think that's a great answer. And I'm going to just add a couple quick details. So for us on the demand side, we think that insurance, exactly like Mandy said, is a trust mechanism to move the demand side from spots to forward purchases and offtakes to investment directly into a project. So ultimately, we want to see it go closer and closer to projects getting that cash investment at as early stages as possible, because we all understand that cash up front is what gets the project off the ground and running, so that ultimately it can sell those carbon credits, which sometimes don't issue until years later. So that's what it looks like on the demand side, where we're seeing insurance as a mechanism to get existing players on the demand side to move further upstream, but then also to bring in new players on the demand side that were sitting on the fence in the past because maybe they felt like it was too risky to engage with the VCM broadly or the specific project. So that is the whole point of insurance, regardless if it's Kita or somebody else, is to de-risk. And then on the supply side, especially with the project developers, of course, getting the demand side to move earlier stage is great for them, but then we're also seeing more traditional finance mechanisms coming into play and available for the project developers, such as banks or larger size financiers that are able to provide debt financing for project developers directly to the project, where previously for those banks or the larger financial institutions, no insurance was a no-go for them, so they wouldn't provide that financing. But now that there is insurance, it is unlocking more financial pathways for project developers to get projects rolling in early stages.
Wait, Rachel, I want to understand how that works. So if it's the buyer who says, I'm going to have insurance, I'm going to insure the carbon credits from this project, then the project developer can go to the bank with that guarantee? Or like, how does that relationship work?
Yeah, it can come out a couple of different ways. Usually we've seen it, I believe the correct term is come out as a tri-party deal, where you have whoever the demand side is, whether it's the corporate buyer or the investor, you're the product developer, and then you have, and let's use the bank as an example, where all three of them would be party to the finance deal in whole. Obviously, each of them have their own part to play, but then everyone would be able to transparently share what they're going to do, what they need to reach that certain stage to make others comfortable. So really bringing in all three parties at once and making sure that each can fully rely on the other.
Okay, that makes sense. Before I move on to the next question, I'll just remind everybody that if you please feel free to put questions in the Q&A. I will reserve the last 15 minutes for our audience questions, so please keep them coming as we go. But Saif, I wanted to turn to you and ask similarly, how have you seen access to ratings change how a buyer responds to a project or thinks about a project, or even how finance can come together for a project?
Yeah, thanks, Margaret. So first of all, I guess one of the things that we like to do is to make our ratings public on a consistent basis. So more and more people can actually access and evaluate these projects without needing to have a subscription or without needing to, have any kind of additional market access. So far we've had several thousand companies, individuals and other market participants actually access these ratings and use it to grapple with what it means with the complexities of every project, pretty much. So I think in terms of, understanding where the risks are, our focus is just exposing some of the core data-driven aspects of that. So, how much carbon is there per credit behind each one of these projects, and letting buyers in on this so that they can make an assessment of whether they want to continue investing in it. I think one of the biggest perhaps issues with the way this currently works today in terms of early stage finance is we can do the best work or the most preventative work in terms of evaluating projects, the earlier we can come into the process. So the later that buyers will leave, using ratings or leveraging these kinds of assessments, the more it's kind of correcting for bias or correcting for projects that they're already looking at, and kind of have already put in their short list, instead of evaluating it from a wider angle or wider lens to say, well, which projects are there that are out there that might fit the mandate that I have, either if it's carbon removals or avoidance or specific jurisdiction or region, and using ratings to sift through that and decide on subset of projects that they want to go fully deep on and get some diligence done on. So I would say that would be probably one of the biggest things that I would point at in terms of improving the way that the buyer process works today, and then hopefully also meaning that higher quality projects get additional funding or get more recognition from buyers.
And do you, like, from your even anecdotal observations of the market, do you notice that that is already happening, that more finance goes to the projects that you assign a higher rating to?
I wouldn't say necessarily that that's the case. I think that there is as I mentioned, I think the space for pre-issuance work is so nascent still, that it means that you're going to get a spectrum. We've got projects that we've rated that are really doing a fantastic job, and some that have fallen far short of the climate commitments that that they put into their draft PDDs. And then also what's helpful is that we compare every one of those pre-issuance projects against its most comparable post-issuance counterparts. In other words, if you're looking at a project, let's say mangrove ARR, we've done several mangrove ARR projects around the world that we can compare that to. We can evaluate how they turned out. We can evaluate the similar projects in let's say Latin America, or specifically, let's say Brazil, where we've done probably the most number of projects, and see how the other outcomes have come out, as well as some of the risks. And we kind of elucidate that so that people know at least what to expect or what some of the risks have been, especially given the fact, like I said, these are future looking projects that haven't yet started doing their proposed changes to the landscape. So I think it's important to not kind of disregard how everything the previous data, what the previous data shows us.
Okay. So ratings and insurance, two different tools to get better insight into a project, how that project might play out, provide transparency. Are these tools redundant, or is there a way that a buyer would link both of them together? Like, how does this fit together?
I would love to start with that. That's one of my favorite points to talk about when we start talking about insurance education with any of our clients. For Kita, I think ratings and insurance are two sides of the same coin, and one is not meant to replace the other. And on a due diligence scale, more broadly, insurance is meant to supplement due diligence. It is not meant to replace due diligence in any form either. So when it comes down to ratings and insurance specifically, we usually see where our clients, especially on the demand side, they've probably already worked with a rater, whether they've just looked at the rating or asked for a review of a project, especially if it's an early stage project. And then they're coming to insurance after the rater, because basically the rater's analysis has given let's say it's just a standard corporate carbon credit buyer. Let's say it's given the corporate either that thumbs up or thumbs down to move forward in whatever type of contracting they want to do. If it's a thumbs down, that project is not going to make it to insurance. If it's a thumbs up, then the corporate is going to come to insurance next, because as I'm saying, insurance is a supplement to due diligence, not a replacement. And I'll take that a step further to also be super clear. In the insurance world, we actually don't look at the project rating in terms of just the wholesale rating as an indicator of if a project is insurable or not. That doesn't mean we don't have high regard for the raters analysis. We actually prefer to look at the deep dive that the raters do on, especially Renoster's work on NBS projects and understanding, like Saif said, around the additionality and the carbon credit baselining and forecasting and methodology related to all of that. So that really rolls into our deeper assessment of insurability too.
Yeah, I think just to like pile on to that very quickly, correlation and causation are two very different concepts. And I think that ties into this. Just because a project is highly rated, that wouldn't entirely imply that the project is insurable or the fact that the premium is going to be cheap for that project. Well, I guess in a very, very crude manner, if we were to look at nature-based solutions, there could be a very high rated project, but it could still be, it could still face wildfire risk. It could still face abandonment risk. And so the way that we look at projects is we always assume that the project is going to be at some risk. And what we're in the business of is assessing that risk and quantifying that risk based on a group of projects. And so what we're looking at is how much risk are we taking on in a portfolio of projects, so to speak. And so we're not looking at projects independently. We're looking at peer groups of projects. We're looking at several projects collectively, and we're looking at the distribution of risk across the board, which is why ratings cannot supplement, the two are not redundant. Ratings kind of lead into insurance and they supplement our process in underwriting, but one does not lead into the other directly, so to speak.
Okay. And could the reverse be true, Menzi, where a project has a low rating, but you provide insurance to that project because a buyer still wants to move forward for some reason, even if...
Absolutely. I think at the crux of it all, what we're doing is identifying risks. And so with the ratings agencies, and I'm sure Seth will be able to fill in more about details about this, but with respect to a ratings agency, they're obviously looking at the project independently. They're looking at, let's say a project has high additionality risk. Now, what we're looking at is what's causing that risk and whether or not we can insure that risk. So essentially, is it because of due diligence? Is it because of the project location? Is it because of the surrounding areas? And how do we quantify that risk in our portfolio of projects, and how much of that risk can we take on? What the rating may do is define the premium in some capacity, but again, I wouldn't go as far as to comment on how much of that influence would actually exist in each of the projects, if that makes sense.
Yeah, I can jump in. So in terms of how ratings and insurance can work together, first of all, I don't think they're redundant. I think that evaluating projects from a third-party perspective independently is critical. And typically that person cannot be the same person that is also insuring the project, because then there is a conflict of interest around, in saying that there is additional risk and therefore charging an additional premium when there may not be that risk. So that's, I guess, the first point to clear up, just in kind of plain speak. The other perspective is we, as a rating agency, are specifically focused on what is the carbon expectations of this project versus the realities, as well as digging into the community co-benefits and then digging into the governance, legality, kind of project infrastructure components of a project, without taking a stake in, the project's outcomes per se, without getting financially involved in the same project. So that is an important distinction that we make for ourselves as a rating agency. But then that analysis is passed along or can be fed into a carbon insurer in order for them to understand better the risks, in order for them to, as Mansi said, and as Rachel added to, inform the premium that they may charge for projects, because we may come up with things in our due diligence that they may have missed, or vice versa, potentially. And there is, I think that's really the crux of how this is supposed to complement each other. But from a buyer's perspective, I think it helps them understand, okay, what are my risks, and then how do I protect against that downside? How do I make sure that there is, coverage for potentially situations where there's fire, or there's a lack of delivery of credits that I'm planned, or I'm expecting for my net zero targets that don't come through for various reasons. I mean, unfortunately, or fortunately, depending on, I guess, perspectives, the nature-based projects aren't a perfect system. There's a whole slew of completely unrelated environmental factors that might have an impact on their existence or their continued output. So having some sort of backup is essentially is very helpful for when you are trying to make an investment today that might take place or span out for the next 10, 20, 30 years.
Yeah, and just drawing on from that, I think, and reiterating what Rachel's already said, the point here that we're trying to make is that the two need to go hand in hand. We don't claim to have authority on things that we don't understand or may not understand as extensively as a ratings agency might, that is solely focused on rating the nature-based solutions. We're experts in insurance, and that's what we understand. We understand risks. But when it comes to individual forestry products, co-benefits, community benefits, things surrounding legislation, things surrounding land ownership, we leave that to the experts, and then we analyze the risks surrounding them, and we quantify those risks, but we don't claim to have authority on all the facts and figures.
Okay, that makes sense. I want to zoom out for a minute. The question I hear most often from a member, like a corporate sustainability team, and specifically the person whose responsibility it is to manage the budget for a sustainability strategy. The question I hear is, if I buy carbon credits, how do I know I actually did anything for the climate? Like, how do I know that that thing actually had impact? So I'm curious, I want to go around the horn and hear each of you, like, what would you say to that buyer? Saif, can I put you on the spot first for that one?
Yeah, no worries. I think it's the central question. When I was buying, I guess in a previous life, I was buying credits, and this is also a really central element. As part of a corporate sustainability team, you're trying to do something positive for the world, external to your own corporation, and perhaps even take responsibility for emissions you put out. And I think one of the best ways of doing that is just evaluate, like actually having some sort of scientific validation that the plan that pretty much the plan is some delta from what would have happened. So figuring out on a scientific basis as you can, if that, the plan is feasible and it will have an impact beyond, the baseline, I think is pretty critical and is how you would assess that and come to an answer of that. And then having some sort of continued ongoing monitoring and checks of that project through time, through, making the investment to year 1 to year 5 and so on, I think is a way of making sure that you check in on whether or not this investment you made maybe years ago is still having the same impact. Or if it isn't, then potentially, expanding or reinvesting in other technologies or in other projects to make up for the delta between what you thought was going to happen and what actually happened.
I want to pick up from that because I think exactly what Saif said on the scientific side is super, super important, and that should be an underpinning of all carbon projects, which we're getting there in terms of that actually being a true statement. And I have 2 answers to add on top of that. One of them a quick hot button, and then one of them a little bit more about the going back to the trust side. Hot button one is if you have the ability as the corporate credit buyer to see the revenue sharing benefit statement, always ask for it. That's a clear indicator that you'll be able to see how your money is going to the product developer and then directly back to the communities and local indigenous peoples that are affected by the project. Unfortunately, going back to the transparency topic, we're not at a stage where those revenue sharing agreements are available publicly for everyone. But if you have the ability as a corporate to ask to see that as part of your contracting, that is really critical, and you'll feel 100% confident that your money is going where you said it would go for sure. And then my other response is on trusting the process, what Nancy was alluding to earlier. And this actually starts in-house with the corporates. You obviously need to have your own internal due diligence process to determine how you end up picking the product and why you're buying that credit. So make sure the due diligence process that you're developing is full and you can be held accountable for it and you can clearly state why you did what you did. That's building internal trust to know that the project that you picked aligns with what the corporate's goals are. And in the case that you don't have an in-house team, like many corporates that have a super robust due diligence process, find those trusted parties, find those trusted third-party experts like insurance, like raters, like advisors to do that for you. That the trust and the partnership, I think, is also really key to making sure the projects you pick are participating in the benefits that you're hoping to do.
I think Seth and Rachel have covered all the points, but I'd like to spin it around a little bit. And perhaps I think the thing that we're missing here in the carbon markets at the moment, when it comes to data sharing, when it comes to monitoring of projects, the key thing is obviously transparency, but also consistency. And they're both lacking extensively. And so when we're asking stakeholders or when we're asking people responsible for the projects to then share information with us, it's almost on the buyer's head to ask for consistency in the documentation, to ask for it in a standard format. So then you can actually go into a ratings agency or an insurance agency and offer that information for us to then assess the risks or assess the impact that your project has created. But I think that consistency factor is a key factor that's missing at the moment. And it's only going to really take into effect if the end user asks for it to the people responsible to provide it. And I think it's got to start somewhere. And I think the way to start with that consistency factor is to actually ask for it consistently and in a consistent format. Yeah.
Very interesting. Or I think when some buyers will publish their criteria of what they are looking for in a project, they can put that in the criteria. It's really interesting. We are getting really cool questions coming in. So I still want to ask the panelists 2 more questions of my own. Go around the horn again. And then I'll open it up for Q&A. So please feel free to keep them coming. The questions we have already are really great. Okay, so 2 more questions for each of you. And like I said, I'd love to hear from each of you about these. One is about regulations. There are so many potential policy changes coming down that could have a pretty big impact on the VCM. I'm curious to hear which ones are you paying attention to and what do you think the impact could be? And Rachel, can we start with you?
Absolutely. I will start on the CORSIA and corresponding adjustment side. Honestly, that's a huge one that's top of pretty much everyone's mind, not just airlines. So I think under CORSIA phase 1, just to set the stage for anyone that's unaware, this is a compliance mechanism for airlines, and it's not just for your travel flights, it's also for anyone that's taking freight or mail or anything via airline as well. And we're currently in phase 1 of CORSIA, which means we are now entering the still voluntary, but it is compliance if you've agreed to it being a compliance phase. And one thing that's really key with this is corresponding adjustments are now required for the airlines that are going to be using carbon credits towards their CORSIA compliance. And an interesting part around this is ICAO, the International Civil Aviation Authority, is the one that's setting the rules and regulations around this. And the key part is the companies that are retiring the carbon credits, if that corresponding adjustment is revoked, they are not the ones held liable for it. It is set up this way particularly to make sure that the airlines are not scared off from engaging the carbon markets on this side. What this means on the flip side is it could be the standards that's issuing the credits that are, of course, eligible, or it could be the project developers as well that are held liable for that revocation of the corresponding adjustment and ultimately the replacement of that correspondingly adjusted credit. So what we're seeing play out right now is the standards, particularly Vera and Gold Standard, who currently have phase 1 conditional approval, are trying to understand how they would make a guarantee to replace CORSIA approved credits that had the corresponding adjustment revoked. And this is really big because how would a standard or product developer account for that? In the insurance world, we are developing policies that actually help directly with this issue, but this is a topic of regulation that will influence the airlines purchasing choices of carbon credits. It could also influence the product developers in terms of what carbon standards or methodologies that they're working with. If CORSIA compliant credits are a focus of their business model. And obviously this is a big area for insurance to come into and help with implementation of this regulation in a smoothing effect.
Okay, Manzi, I'm curious to hear from you. What policies are you paying attention to?
I think Rachel covered the key concepts that we look at. In terms of policies that support that, we're looking at political risk insurance primarily at the moment. And that's obviously very data driven, where the way in which we're trying to assess it, the way in which we're trying to analyze it is very, very data heavy. And we're seeing a lot of demand for products such as these, given that A, insurance is starting to be available for risks surrounding these, and B, data-driven decisions can be made surrounding these regulations. But yeah, that's essentially what we're looking at. I can go into a little bit more detail surrounding our product, but I don't know if that's the focus of this call. So.
All right, well, we'll put a pin in that. And if we have a couple minutes, we can go a little deeper on how you do that. But just to keep us moving on this question, Saif, what potential policy changes are you tracking?
Yeah, there's it's interesting space, because I think a lot of the most impactful ones are pseudo-regulatory or quasi-regulatory. So ICVCM, CCP labels are supposedly coming out in the next quarter or so, I think actually in July. And then STBI is finally deciding on whether or not the will they, won't they drama, I think, should come to an end, and they'll figure out whether or not they would like to have carbon credits be part of the scope 3 emission claims that a company can make. And I think that's going to have a huge impact on adoption, uptake. I've heard a lot from buyers that are waiting for CCP labels as an additional check on the market, as supposedly a floor, but we're watching the space, but curious to see how much of a floor it will be and how thick of a sieve it'll actually be on the market. I think one way that it won't be successful, if I had to put it, kind of bluntly, is that if it let in too many projects or too many methodologies. And I think the other part about it is, by evaluating only methodologies, it's not a catch-all per se. So we've seen this time and time again, where good projects exist under bad methodologies or poor quality methodologies, and vice versa. Good projects exist, or rather bad projects exist on high quality methodologies. So it's going to be interesting to see how it affects buying. I think we will definitely see an uptick, but I don't know if we'll see a decrease in controversy.
Okay. Last question for you all before I open to the audience Q&A. The four of us are going to talk again next year. Next June, we're all hanging out again. I'm curious, what do you think has happened in the voluntary carbon market at that time? And what do you think is the most important thing that could have happened that we would be talking about? So what are the biggest changes in the next 12 months? What do you really want to see happen? And it's probably very related to what you all just said about policy changes. But Manzi, what about you? What are we going to talk about next June?
I mean, given my role, I think my answer is always going to be consistent. I would love to see a lot more data-driven policies being made, a lot of data being transparent, people actually talking about what they're buying, what they're selling, being upfront about it, how they're using those credits, whether they're offsetting their emissions or whether they're just holding credits. All of this information is really crucial for us to understand risks surrounding these credits, and also to understand how much of the prospective emissions we can actually offset in the future. I think there's a huge gap between people's understanding of how many credits are available in the markets at the moment, and just how much emissions they can actually create without being held accountable for them. And I think what I would love to see in the future, I'm unsure of whether or not this is going to be possible, is data transparency. And so companies just being very, very open and transparent about the emissions reductions they're contributing to, and just how many projects they're contributing to, where these projects are situated, what communities they're benefiting. Just that entire conversation surrounding that, I think would be really, really crucial. And the more that this is factored into standards and methodologies and insurance companies' requirements, ratings agencies' requirements, the better it is for the wider market, whether it's to do with Article 6 regulations, CCPs, CORSIA, etc. And so the data transparency, data consistency are the two key things that I would love to continue talking about and that I would love to see a lot more advancements in.
Yeah, I'll jump in on that. I'd love to see the promise of VCMI play out in reality and get, you know, standardized disclosures from companies about projects that they've invested in, and get, you know, kind of be open and honest about, you know, mistakes that may or may not be made. I think the reality is we're going to make mistakes. But the ones that, you know, really move the needle are the ones that can own it and kind of move on and continue to make up for their carbon balances. I think one of the biggest things is seeing how the supply versus demand curve wears out, because there are I think 2 billion CDM credits still in the market that need to be hoovered up or cleaned up by the registries. But no one's going to, you know, be buying those. I'm curious on the capital that we talked about at the front end of this call, how that gets deployed and to what extent it is deployed, and how that spreads out between removals and other types of projects. I think ideally, and I don't think this is what's going to happen, but I'd love to see kind of the bifurcation of avoidance versus removals stop, and for people to realize that carbon avoidance can be a suitable form of carbon against carbon emissions that they can count against their budgets. But by using insurance and by using ratings, they can get around some of the big issues by over retiring credits, for example, and being responsible about their usage of those credits.
And then I'll round us out with market size will be much clearer next year from the quality standpoint on one side and correspondingly adjusted credit availability on the other side. So piggybacking off what Saeed was saying about ICVCM, this morning they dropped the first 7 methodologies that were CCP approved, all ozone depleting substance and landfill gas. And I believe ICVCM's goal is to have 50% of all credits in the current VCM to have their CCP label as a clear yes or no. So that'll be really fantastic. And then obviously that assessment will continue through next year to get to that 100% review. And then CORSIA, we're expecting by the fall to understand the final standards that are phase 1 eligible, which will obviously open up the volume of credits that could potentially receive the corresponding adjustment and get that CORSIA approval too. So those are 2 elements that we'll see play out very clearly in the next 12 months that'll influence market size.
Okay. I'm looking forward to that conversation with you all next year. And Saif, I just wanted to sort of double click on one thing you said, which is it possible to make a mistake and have that be a part of the process? It's not a devastating thing, but it's how we are working together on this like massively complex problem as a planet. That's what I want to see in the next 12 months, to change how we talk about this thing. So we just do something, you know, perfection is the enemy of good. I think that would be a wonderful change to see. So, okay, now we're going to move to audience Q&A. Again, thank you all. There's really good questions here. So we're going to try and get to as many as possible. So here's the first one we got. Aside from securing funding, have you seen any other benefits for VCM players in taking insurance? For example, a premium for the credit. And I think we could also ask this questions about ratings. But Rachel, I'll turn it to you first. Other benefits in the VCM from taking on insurance?
First, direct response on the premium. Yes, we're definitely seeing product developers and even intermediaries, especially on marketplaces, using the fact that they have insurance or a project is able to get insurance as a USP, specifically around increasing pricing for carbon credits. There's definitely not enough data yet in the carbon insurance space to confirm that from a data perspective, but we are seeing that start to take shape in the early phases. And then I think the biggest thing in terms of the benefits, and I'm going to directly quote our head of insurance, James Clinch, on that, where he likes to say that if for insurance, you're trading the unknown risks that could come in the future for the very known cost of the insurance premium. So that is obviously a huge benefit where if something does go wrong, the insurance is there to cover you and make you financially whole again.
I'm just going to quickly double down on something that Margaret mentioned earlier. In terms of knowing whether or not your your actions, your credits are actually making an impact, insurance can be a very cool, very useful factor in that, because we will know whether or not it's creating the intended impact. And if it's not, that's when insurance kicks in. And so if you do have insurance, you can be almost sure that whatever credits you're buying, you are actually offsetting the emissions that you intend to. Yeah.
Yeah, from the rating side, I can comment. So I think the fundamental thing is on buyer confidence, and making sure that they actually can jump into, securing a longer term offtake with a particular project, or feeling like they have more of an understanding of what the project actually entails in order to market it or in order to talk about their involvement in the project. I would say those are two main things that ratings can benefit, aside from securing funding.
Manzi, back to what you said, is that because the insurance can be paid out in carbon credits?
Yes, absolutely. So we do pay out insurance and obviously money, but also credits. And Kita is able to secure investors with like-for-like credits at the moment. And so the point I was trying to make is if you've bought a certain number of credits that are supposed to offset X amounts of emissions from your company, from your individual emissions, if the project comes to fruition and you actually get those credits, great. If you don't get those credits, you're either going to get the money back or you're going to get like-for-like credits. Either way, you're free to continue to make impact against the climate change crisis. And so you will know whether or not your emission reductions are actually coming to fruition.
Okay, that was a fabulous segue into our next question, which is about buffer pools, which have been, I think, the traditional insurance tool. So does insurance compete with or complement the buffer pool mechanism?
Hopefully complements. I say hopefully because Kita is actually working on a buffer insurance policy. We've already made a couple of announcements with Ox Carbon, International Carbon Industry, and Ecosystem Restoration Standard to be able to supplement insurance for their buffers, which Nancy is definitely the expert on how this works in practice, but in sum, it provides a more accurate risk assessment for the credits that are within that buffer pool. So we can really target what projects are doing best, what projects are not performing as well, and be able to super fine tune the amount of credits that should go into the buffer pool. And also, if there is a devastating withdrawal from the buffer pool, the insurance can also act as a mechanism to allow the buffer pool to rebound as well and give it some breathing room to build itself back up so that you don't have a buffer pool collapse, which obviously has not yet happened to my knowledge in the modern VCM, but you know, we are in the business of the extreme risk. So that is something we think about. And so yes, we would like to see it implement, especially because considering project developers do have to contribute some percentage of their carbon credits to the buffer pool. That's a direct amount of credits that they then cannot sell, which limits their own revenue stream. So we think insurance can also on the buffer pool can have a direct impact on project developers too. And I'm actually really curious personally, Saif, does Renoster have an opinion on the buffer pools? or is that completely separate from y'all?
I mean, we have opinions on how methodologies leverage buffer pools. I think we also got a lot of opinions on how buffer pools have not been activated, even though there have been very systemic issues with overissuance in certain project types. But as a whole, I think that they're an important component of any good methodology, and they should exist. But they should be leveraged. They should be leveraged in instances where they call for it. And we'd love to see that more and more from registries.
Okay. I'm going to move us on to the next question. This is also about insurance. Really interesting question. Have you observed a correlation between who initiates a project's insurance coverage, meaning either the developer or the buyer, and the credit pricing? As a developer, we've seen a clear toggle between the amount of upfront capital provided and the negotiated delivery price, influenced by who assumes the risk and when. Rachel or Manzi, do you want to take that one?
I can start with that one. I think this is a piggyback off of the previous question for sure, where if the project developer is taking on an insurance policy, they would more than likely increase the cost of the carbon credits for good reason. They now have a direct protection for their client so that they feel more secure in doing that contracting, and of course more security does cost more. So I think especially if the project developer takes it on, then there will be an increase in carbon pricing. Not that it has to be, but we are seeing that trend. And possible if Saif wants to comment on this too, we obviously again don't have the data for that, but we are kind of looking at this as a proxy for carbon credit pricing and their ratings too. So obviously we're seeing as a project does a higher rating, goes for a higher price. We're expecting that insurance will follow that trend.
Yeah, I mean, I can comment a little bit about price versus quality. We're coming out with a lot of reporting about this right now. And I think ultimately we haven't seen a comprehensive or conclusion at all between the two variables across all the projects we've rated. So it doesn't seem like there is any clear or cut and dry trend. I'd like to see that emerge where projects that have insurance and have high rating get a higher price, but in terms of the existing market, that's not been the case.
Okay, I think we have time for two more questions. So this is one I'm going to direct to you, Saif. This is kind of a long question, so I'm going to read it out. On the data transparency issue, you can also make an argument that this is structurally hampered given current market infrastructure. Standardization of data across registries is still poor, methodologies, MRV process, et cetera, is disparate. So that heterogeneity might put the onus on the buyer to ensure data quality, but that doesn't mean that it might unlock bottlenecks to quality. So can you talk about this issue of data heterogeneity?
Yeah, I think this is pulling at a really important thread, which is that there are as many unique hoops and procedures to jump through as there are methodologies within registries. And I think that one of the things we'd like to see is more clarity and transparency about how those methods work in a kind of plain speaking public setting, without needing to be a carbon expert or without needing to be having a forest science PhD in your back pocket. I think that we've seen some movement towards this from newer registries like Open Forest Protocol, from International Carbon Registry, as Rachel mentioned. And I'd like to see that methodologies become more and more open about how they, pass or don't pass projects. I think that the lack of clarity on that hurts buyers. It puts them in a position where they don't know necessarily without, spending. And again, these are usually not what these companies are set up to do, right? They're like multinational, corporations for all sorts of topics that don't necessarily have a resolute remote sensing team as well. They need to have more clarity, more transparency around what this project is actually saying, regardless of ratings. I would say, like, just coming straight from the registry, because at the end of the day, they are they are telling you that there is a ton of carbon here for every credit, allegedly. So, what is that actually? What are the rules by which we are creating that? I think that needs to be much, much more clear. So I would agree with the point, which is I think it should start from registries, and that will in turn help buyers and unlock the bottlenecks.
Okay, I'm going to get one more question in under the wire here. I think it's a quick one, though. It's for you, Manzi, which is, do insurance companies require a report or analysis from a rating agency, or would the third-party validation and verification report be sufficient?
I wouldn't go as far as to say that the ratings report would be absolutely essential in our underwriting procedure, simply because all the information, I think this tunes into something that we've already talked about, which is the data that the ratings agencies are looking at is consistent with the data that we look at. And so one would supplement the other, but one is not an absolute necessity. And so if we were just provided with a third-party validation and verification report, we'd go as far as to analyze the project in our own rights and assess the risks of that project in and of itself. A ratings agency report would be super helpful in actually grasping the risks and would supplement our analysis. However, if it wasn't there, that wouldn't be a drawback, so to speak, for the project or the obligor or whoever's asking for insurance, I wouldn't say. And that's solely because we do conduct our own due diligence as well. And we do look at all different factors that a ratings agency would look at anyway. It's just one would complement the other, but one's not a necessity.
Okay, we're at time. That's all we had time for today. So thank you all so much. And thank you to the Kita and Renoster teams for bringing us together. I think somebody did ask if the slides would be available, and they will be shared out, I suspect, to everybody who registered for the conversation today. So thank you all so much for joining, and thank you all so much for a great conversation. Have a good one.
Thanks, everyone.